Well, good afternoon, ladies and gentlemen, and welcome to another Travel Mile broadcast. And today we're going to be talking about a subject that dear to the hearts of many an industrial leader, and that's the valuation of their company and what they may do with that valuation. And in order to get to the bottom of where we are today, I have Morgann from Cambon and Partners. Good afternoon, Morgann.
Good afternoon, Graham.
How are you doing?
Very well, very well.
Good.
Super busy. Travel tech is a booming market, but it doesn't affect all companies the same way. So I'd say it's a booming market for the companies that may manage to find their way within a troubled valuation environment, I would say.
Okay, so we had a little chat beforehand. You were talking about the current environment that in number of companies' valuation will actually drop and has dropped already. The end of the revenge travel, or if not now, when will that end soon? Rising interest rates, all sorts of other ingredients are coming in. What's your take on it? Why are people's valuations lower? On the face of it, you would say that the travel industry is booming at the moment.
Well, I would say revenge travel is still here. I would say we still see very nice numbers for travel vendors. People are, hotel airports are fully booked, planes are booked, hotels are fully booked. So I think for the professionals in the tourism industry, things are going well. A summer 23 is going to be a good summer. How does it impact valuation these days? I would say it would mostly impact the companies that are subscale. So scale definitely is a very important factor when it comes to approaching the valuation of a company. So what we found out is valuation has been always I'd say a parameter of balance in the valuation. So where you can see on the one hand companies growing strongly with strong profits. So companies growing more than 25% year over year, plus adding like 20 to 30% EBITDA margin with low churn. This company, assuming they're at scale, meaning more than 10 million euro of net revenue, this company will benefit from a scarcity effect, because there's a lot of money in the market, but that money only would go to models or companies that have shown their ability to keep growing in a troubled environment. So on the one hand, you have these companies enjoying a very strong valuation. We can still talk about like 15, 20, 25 times EBITDA. And on the other hand of the spectrum, when companies are subscale, meaning below 10 million euro of net revenue with low profit or no profit, then these companies have a hard time finding money, finding investors, and in valuations are coming down significantly in that bucket of companies.
So if I own a company, say I own a travel tech company, I've been running it for 3 or 4 years, I'm below 10 million, below those parameters that you identify. What would you? And I got approached by another company to maybe buy me out, or I got approached by an investor. You think that's a good move to listen, open your ears to and listen to those people at the moment?
Well, obviously, if someone is knocking at your door, you probably want to open the door. That's that would always be my approach. If people are keep pushing you or showing a strong interest in your company, just please make sure that you give them sufficient attention. But it's going to be quite unlikely that valuation wise the valuation you're going to be offered are going to be interesting. So what do you have to do if you're the owner of a small company subscale? You probably want to wait. If you have the ability to wait, you probably want to wait, because there will be no further funding for your company these days. On the other hand, if you have a company at scale, and you've shown ability to do M&A, you're brave and you've been courageous enough to keep the M&A, to try the M&A option, then you certainly want to go to market, because there's going to be funding for you to help you continue your M&A on your M&A path. and probably valuations will be at a very decent level. So this is the way I would see, like, if you can afford, waiting, go ahead, wait, because in a troubled environment, if you're subscale, it's going to be a very complex path for you. So if you can afford waiting, do wait. If you can't afford waiting, be prepared to severe down rounds of severe valuations.
In terms of mergers and acquisition, if you're a bigger company and you're looking to acquire a smaller niche player or some piece of technology that might fit into your overall portfolio, is that market vibrant? Is that a bullish market at the moment?
Yeah, no, for sure. So if you benefit from this kind of a tailwind, and your company big enough, you can go shopping. You can go shopping because there's not a lot of buyers for small companies, and if you happen to be one of the only buyers in this sector, then you will enjoy the benefit, the privilege of being almost alone in a very low competitive process market. So I would say go shopping. It's a good moment if you're a buyer. It's a good moment to buy companies at a lower multiple than your own multiple. So you would combine the interest of buying a company that is synergistic to your company. So always look for synergies first, and then look for the multiple improvement. So if you're I don't know, if you're 10 or say a 20 million net revenue company with a 25-30% EBITDA margin, your multiple is probably around like 15 times EBITDA, right? You can certainly buy companies if they are EBITDA profitable, something like for between 5 and 6, 7, I would say. If the company is not EBITDA profitable, you can buy it for 2, 3, 4, 5 times ARR, which is the annual recurring revenue.
And what about if you've already got skin in the game? Say you're an investor and you put skin in the game, say 2 or 3 years ago. What's your appetite now for some of these smaller startups? Is it a question of, I want to get the hell out of Dodge, or I'm prepared to put more money in, or is it just dependent upon the company?
That's a good question, because I would say most investors that have skin in the game in small companies would certainly be tempted by exiting sooner rather than later. So I would say these investors can be scared about the future, and will probably want to seize the first opportunity to divest. So this is what I see in the market. Investors trying to introduce me to some opportunities where they want to divest. So there's a lot of buyers. There's a few buyers these days. There's a lot of potential sellers, but not everyone is prepared to sell the asset at a lower valuation than the one they invested at.
Fair enough. So in summary, if you're a 10 million and above euro net revenue company, now is the time to be very steely and think, who can I acquire? How can I build my company by acquisition, by merger and acquisition, rather than build it yourself? And if you're 10 million below or a startup, if someone comes knocking on your door, at least open the door and listen to what they got to say.
Yeah, maybe I would amend slightly what you said at the first option. If you're a 10+ million net revenue company, don't maybe M&A. M&A is probably a good option for you, but make sure you have enough organic growth embedded, because don't see M&A as the only way for you to grow. Make sure your business is healthy enough to grow organically by itself, like 20%, say, year over year. And on top of that, add an M&A option as a multiplier to your growth. But make sure that you have healthy organic growth before going to M&A.
That's very, very interesting, Morgann. Thank you for your time. I think if anybody needs guidance, investment bankers are in your portfolio of employees, they should come and speak to you. That's correct, is it not?
Cambonpartners.com.
Cambonpartners.com. Thank you very much.
Thank you very much, Graham.
Bye.